All right, long time no see. Welcome back to the channel. I've got a lot of videos to catch up on, and we're going to start here with Amazon. So we're going to talk about Amazon's earnings, some of their competitors' earnings, and the market sentiment, not just on Amazon, but a lot of the consumer discretionary stocks. As we can see here, Amazon's on a nice healthy pullback from its all-time high of 242. We're currently at 215, but still in a very long-term uptrend here. I'm still very bullish on the stock. None of this is financial advice. Do your own homework, do your own research. These are just my thoughts and my analysis. So we'll come back to the chart here in a little bit. I got a lot of programs running on my computer. It feels like it's going to have a heart attack, so we'll see how this goes. Let's take a look at some of my notes here. So Q4 earnings, Amazon, $188 billion in revenue for Q4 2024. Walmart just had their earnings this week. Walmart was $180.5 billion for Q4. This is the first time Amazon out-earned Walmart in quarterly sales. That's good. So Amazon, I still believe, will be the first company to get $1 trillion in revenue in a yearly yearly run rate. I don't think that'll be this year, but potentially in 2026. We'll have to wait and see. Amazon's numbers, they do fluctuate quite a bit. I do believe their guide for this quarter was $150 to $160 billion for Q1 of 2025, which is to be expected. Q4 is one of their busiest years with the holidays, so that makes sense. It is a 10% year-over-year revenue, which was a beat on their last quarterly numbers. The big driver here is Amazon Web Services. Now, this is the big deal that Amazon has that Walmart doesn't. So if Walmart dips on their consumer side, they don't have AWS to pick up the slack. If Walmart's margins miss on the consumer side, they don't have AWS to pick up the slack. Now, Walmart is pretty big, but so is Amazon. So these are just two Goliaths. This week with Walmart's earnings, we'll talk about in a moment. The market didn't like it, and then today we got some more economic data, which was not good. So that is kind of weighing down some of these stocks here. Advertising for Amazon was up 18%. Amazon's a huge player in advertising, which is a big surprise to me. I learned this the last couple of years. I didn't think that. I thought deodorant comes to you, your doorstep, and then I thought AWS. But they have a lot of pieces of their business that are just cash cows, which we'll see some graphics here in a moment. Let's see here. The Capex, we'll talk about this as well. Amazon is planning to spend $100 billion in 2025 to build out their AI data centers or whatever they're looking to do when it comes to competing with the other big tech companies. So that is the most of all the mega cap tech companies. They're also really pushing forward their custom chips and their Bedrock LLM services. So NVIDIA is very much an AI play. It's also a data center play. It's also a cloud computing play. So they're involved in a lot of different things. It's an advertising play. It's a consumer play. This is, in my opinion, the easiest and obviously one of the best stories in the market. If you had to close your eyes and hold something for 20 years, to me, this is very high on that list. They're in so many markets, and they are a leader in so many markets, and they have the cash flow to build an advantage and an edge in all those markets, and then also find new markets. They're also entering in space and satellites and things like that. So they just have a lot of things going for them, and they're a cash cow, so they can fund those projects. All the big mega cap tech stocks are like that as well, but Amazon especially. The online stores was up 7% year over year. Third-party selling up 9%. They're competing with Temu and Shein. A tariff loophole is in play. Not sure what that is. We will see how these tariffs affect all these businesses, mainly how they get around these tariffs. Prime Video ad tier boosted their revenue. I've been watching a lot more stuff on Prime. They do have a lot of content on there. So they are growing there. That's part of the advertising. They got the James Bond deal this week, so that's another piece of their pie here. Let's talk about the Walmart overhang. So Walmart's Q4 earnings, we talked about that. Their outlook was poor. Their outlook was for about 3% growth for Walmart. That was shy of experts' expectations. So that kind of pulled back Amazon. And then this morning we had a very weak consumer sentiment reading. So the consumer is not very positive. That's not good for Amazon. That's not good for Walmart. That's not good for Tesla. That's not good for any consumer-facing company. But that is just 1 month's data. Who knows what next month or beyond will look like. Short-term headwinds, foreign exchange, macro uncertainty. There's a ton of uncertainty with tariffs, with inflation, with interest rates, with Doge, a lot. Is there gold in the safe in Fort Knox? There's all kinds of uncertainty, which is why we're going to continue to see a lot of market volatility. Once we get clarity, the market will see, hey, these companies are doing really well, and now we've got some of those headwinds behind us. Let's go buy and let's go back to all-time highs. We did hit an all-time high, ironically, yesterday, and the market's pulling back aggressively today. Real quick, while we look at the technical levels, let's pull up the chart. I have been dollar cost averaging in Amazon at the 220 level. So starting yesterday and today, I've been nibble. This is already the second largest position in my portfolio. Again, this is not financial advice. Do your own research, make your own decisions. But wouldn't surprise me here if we get a little support at the 215, 210, and then the next support is going to be 200 or so. Now, we could just fall down to 150. We did that last summer. Great buying opportunity. But this is a company that I don't see getting out of this long-term trend unless really bad problems happen in the economy, which there could be some things that break. There could be some turmoil, and you zoom out, and this does look a little sketch because we're at a recent top. But it also looks sketch here, and we keep chugging higher because Amazon's earnings keep chugging higher. We go from 120 billion in revenue to 134 to 140 to 165 to 140 to 150 to 160 to 190. So this is still a growth company. So we'll see where this stock will reverse, or maybe we're at the beginning of a reversal to the downside. We'll have to wait and see. This is a long-term hold to me, so if it keeps going lower, that gives me an opportunity to buy more shares at a lower price. I've been saying for the last couple of years, Amazon's a sleeping giant. Amazon's a $230 stock. Okay, the giant has woken up. We've broken out of this 4-year base where we've really gone nowhere since the pandemic. We gave back all those gains from the pandemic in 2022, and we've been on a nice run. So if this year's a wash, that's fine. The fundamentals of the business are still looking very good until the fundamentals change. I'm not too worried about the ebbs and flows in the stock price. Let's go back here. So they are an AI play when it comes to the outlook, a robust AI cloud play with all these investments, but there is a cautious consumer. Advertising revenue looks good. Capex for data center looks good, but that is going to also hurt their margins because they are spending so much money. Let's go ahead and take a look at the income statement. 187 billion in revenue, 20 billion in net profit, 90 billion in gross profit. You've got the online stores bringing in 78 billion, 7% year over year. The Whole Foods physical stores, 6 billion, 8% year over year. Third-party services, 48 billion, 9% year over year. Advertising, 17 billion, up 18% year over year. Subscriptions, Prime and Audible, 12 billion, 10% year over year. I feel like they could double their price for Prime and no one would cancel. I wouldn't cancel. AWS, 28 billion, 19% year over year. Everything is growing in almost double digits. So they're still a growth company. Their total revenue for Q4 is up 10% year over year, which is phenomenal. And again, you can see half of their profit is from AWS. That's their cash cow, and that's the fastest growing segment of their business. Advertising is right behind them. So when we look at revenue growth for AWS, it's hard to grow at these high numbers as they get bigger. So it started to normalize. We started to accelerate. Now we're just kind of staying put at this steady 19% revenue growth year over year, which is phenomenal. That is phenomenal. And with the whole AI revolution, I still think this is going to continue to stay steady, if not continue to grow. But even if it does start to decline a little bit, the growth rate, they're still growing. That's still a good metric. Cloud infrastructure market share, they're the big dog in the cloud infrastructure. 30% is AWS, 21% is Microsoft, 12% is the Google Cloud. Huge. Tier 2 providers, okay, that's great. AWS, again, phenomenal business here. You see the revenue in black, and you see the operating income in the orange. These are just great charts. Advertising revenue, so we're looking compared to Google, YouTube, Meta, and Amazon. Now Google's another one very high on the list because Google's got two of these big dogs here when it comes to advertising. So Google is the leader when it comes to advertising for search, and then they also have YouTube ads, which is, it's small on this list, but you put those two pieces together, Google's head and shoulders over everybody, and Meta is a close second when it comes to all of their apps. But Amazon holding up. Amazon has more advertising revenue than YouTube. Kind of surprising. Capital expenditure. So you can see all of these companies are really spending. Amazon's the most aggressive. This has been the case for Amazon. It's a story as old as they are. They are not so focused on profitability. They're focused on growing revenue. And over time, as they see themselves as becoming more and more mature, they still see themselves as a very young company that has a lot of market to capture. So they're not going to focus on profitability. They're going to focus on grabbing as much market share as they can. That's why they keep reinvesting so much. But all these companies are continuing their spend, and it's really had a huge increase since ChatGPT and AI really was let out of the box, and Amazon is no different than all of them. But it's still $20 billion more than the next when it comes to Capex, and the next is going to be Microsoft. So that is really all I got. We can go over we can sum it up here with the bull and bear case. So bull case, Amazon Web Services, the ad growth, you've got the whole Prime ecosystem. I'm never going to cancel my membership. Like I said, I think they could even double their membership. It's one of the lowest churning subscriptions out there. Netflix has a huge churn. I would say Prime and probably YouTube are the most steady when it comes to people not canceling their membership. Now, their valuation, it's not that expensive because they are really growing into their valuation. Amazon has always been a very expensive stock. But their price to earnings is below 42, which is below their historical average. So there's room for multiple expansion. But if the whole market comes down or if interest rates keep going up, multiples will compress. But Amazon's never been a cheap stock, but you get what you pay for. You're paying for a phenomenal company that has multiple business streams that are continuing to grow at over 10%. So that's why you're going to pay a premium. You know, a house in Maui or a house in Hawaii, you're not going to find it dirt cheap. You're going to pay a premium because you're getting a premium product. So that is the case here for Amazon. But when we look at its valuation currently, after this recent pullback, it's not that expensive. So yes, we can always compress more. We can go lower. But to me, this isn't a terrible price to pay for a phenomenal business. So a quote that I love and that is seared into my brain, it's not what you buy, it's what you pay. So to me, this is buying a phenomenal business at a good price. I'd rather do that than buy a terrible business at a terrible price, or a great business at a terrible price. To me, you're getting both sides of those equation, a good business at a good price. Now the bear case is how weak is the consumer going to get? Their guidance miss for Q1, similar to Walmart, was a little softer than people expected. And then the cloud competition. You do have a lot of competition from Microsoft, Google, and all the other players in the cloud. how fast are they going to continue to grow and maybe take some of the pie from Amazon. And the high capex, you could look at that as a drag on the short-term margins, or you could look at that as investing in the future and turning that money into reoccurring revenue down the road, which Amazon has a great history of doing. They're one of the best companies out there when it comes to reinvesting their profits into other growth metrics for the business. So to me, I'm not too worried about the bear case. I think there's much more to be bullish about than the bear case. I think a lot of the bear case can be, it's not an Amazon specific story. A lot of the bear case would be a market specific story. So that is all I got for you on Amazon. Great quarter, great business, and I will keep you guys updated on any other news that comes down the pipe. So have a great rest of your day. I'll talk to you later for the weekly stock market update. Until then, peace out.